Good afternoon, everyone. I'm Pranay Sharma from S.MONK, and today we are going to start our first lecture for CM2, Core Mathematics 2. Okay. Now, before we go into the course of CM2, what do we require from CM1 as well as CS1 in this CM2 so that you make sure that you are well versed with all those topics. Okay. So in our CM1, we had two parts. We had financial mathematics and we have life insurance, right? So everything that we did in financial mathematics is going to be important. Maybe not everything, but our annuities, then project appraisal not so much, but bonds, term structure, these chapters are going to be very important. Okay, so of course interest rates, that will be important. Okay, so from CM1 we are talking about interest rates, annuity, bonds, and bonds, the whole chapter. Okay, so I'm writing it in short. We are talking about bonds, equity, and property, and term structure. These are the chapters that are going to be important for us from CM1. So by any chance, if you feel like you have to revise, go and revise these chapters, because we are going to use these chapters throughout our CM2 course. Okay. And from CS1, we'll have our probability distributions, that will be important. CLT, sampling chapter, then point estimation, confidence interval, and hypothesis testing, that will be important, and linear modeling will be important, linear regression. Okay, especially probability distributions, we tend to forget a lot of things from our distribution chapter. We are going to use that a lot here. Gamma distribution, log normal distribution, the distributions we did not use a lot in CS1, we are going to use here a lot. Okay, beta will also be used a lot here. So just go and revise your probability distribution chapter. Okay, that would be important. These are not very we'll not use it a lot, but small points we'll be using throughout our course. Okay, so these are some prerequisites, CM1 and CS1 topics that we'll be using here in CM2. Now what is CM2? Our CM2 course is about financial modeling for investments. So CM2 is financial modeling for investments. Okay, so we are going to learn how we create models, and using those models we are going to then figure out the future values for investment, or you can say we can predict what might happen in the future. So that is very important. Whenever you're talking about investments, your aim is to know what would be the price of whatever stock or mutual fund or property or bonds that you are trying to buy today, what would be its value in the future? That is what you are trying to predict, and CM2 is all about that. Okay. Now CM2 goes to the very basic of the financial modeling. We are going to learn every small details through this CM2 chapters. Okay. Now when I say investment, when I say we are learning investment, I think everybody first thing that comes into mind is stock market, right? So stock market is not the only place where we invest, right? So can you tell me what are the other places? When I say investment, what are the other places of investment that comes into mind? Okay, so first is stock market, right? Anything else? You can write in the chat, or you can unmute yourself and talk to me. That will also be fine. So we have debt instruments. That's good. We have real estate. Okay. Futures, good. Options. Anything else? These are all places of investment. There are many more. Okay. We have forward contracts. Forward contracts and futures are very similar but slightly different. Okay. Futures and forward contracts are very similar. In terms of mathematics, they are the same. Just futures are dealing with currency, whereas forward contracts are dealing with goods. Okay, that's the main difference. Then simply we have mutual funds, and nobody said mutual funds. You don't invest in mutual funds. And we can just have fixed deposit. One more thing that you all missed that is very important, or you might say one of the biggest investments in India. Do you know what's the maximum amount of Indian people's money invested in? Gold. Yes, perfect, gold. Okay, we'll be talking about gold, but it can be any commodity. Okay, there can be investments in commodity market. So there are so many places to invest in, right? Now stock market, debt instruments, very similar to each other. Okay, real estate and maybe gold and commodity markets are very similar to each other. Futures, options, forward contracts, very similar to each other. Of course, options are different, very different from futures and forward contract, but we build over what we learn in futures and forward contracts. Okay, then mutual funds, fixed deposit. Okay, we might club them together. Now basically mutual fund is nothing but somebody says that to I will invest in all of these in small percentages. Okay, but when we go to buy, let's say Tata stock is, let's say, at around ₹1,000. Okay, and if I have only 5,000 rupees, I may be able to buy only 5 Tata stocks. And if I want a Tata stock, Reliance stock, Birla stock, whatever, right? So the problem would be that I'll not be able to diversify my investments. Correct? So I don't have a lot of money. So what should I do? So mutual funds, they pool people's money. Okay, pool people's money so that we can invest in a large diversified portfolio. We are going to learn how do we diversify portfolio, or what should be strategies there is hedging, there is other types of diversification. How do we diversify our own money? Okay, mutual fund does the same thing, but rather than one individual's money, they will take money from a lot of people. They'll pool money from a lot of people and then invest. Okay, so they are investing in majority of these things only. Okay, now fixed deposit, I think everybody knows what fixed deposit is, right? We go to the bank, we say I have certain amount of money, let's say 1 lakh rupees. I want to give it to you for, let's say, 1 year. Okay, and after 1 year the bank will return me money with interest, right? So it's a fixed deposit. Amount is fixed, term is fixed, everything is fixed, the rate of interest is fixed, everything is fixed, there's no variability there. Then we can have stock market investment. Now if I say rate of returns, okay, usually fixed deposit will give me the lowest rate of returns. Let's assume 5%. Okay, let's assume fixed deposit is giving me returns of 5%. Then mutual fund is, let's say, giving me returns of 10%, and stock market is giving me returns of 15%. Now where should I invest? Among these three, where should I invest? Can you tell me? Where should I invest? Okay, Dheer says diversify in all. That's a good option. But let's say I have only option of buying one of them. Should I invest in stock market? Should I invest in mutual funds? Should I invest in fixed deposit? Now, okay, that was a tricky question, because we'll say this is not enough information. If just based on this information, I would say the highest returns is in stock market, so I should invest in stock market. Does that make sense? If I say just by looking at this 15%, 10% and 5%, I say, okay, I am getting the highest returns in stock market, I will invest all my money in stock market. What would you say? Would you say that's a good strategy? Yes, it's a risky strategy, right? So this is not enough for me to rely on when it comes to information. If actually I am just looking at this information and I'm investing, the best investment would actually be fixed deposit. Do you know why? Because I'm not considering risk at all. Okay, so there is another factor that we'll always consider. So this is returns, and we should also consider risk, right? The reason Dheer said that we should diversify into mutual funds, fixed deposit and stock market is because there is high risk in stock market, right? High risk. This would be, let's say, medium risk, and this would be low risk. So stock market has a high risk. The biggest risk is I will lose all my money, right? The less risky thing, or when I say high risk, yes, there is a big risk that I will lose all my money, but that's not the only risk. When I say that I am getting 15, I'm expecting 15% returns. If I'm expecting 15% returns and I get only 12%, that is also a risk that I am taking, right? Because maybe I planned all my finances according to the 15% returns that I was expecting. Okay, let's say that I invested 100 rupee in stock market and I was expecting 15% returns. So I was expecting 115 rupees back after 1 year. Okay. And I was going to use that 115 rupees and give all of you a party. Okay. You'll say 115 is too less for a party. You can make it 1000, right? So 1150, I was going to give you a party. We decided all the place, we decided what we are going to eat. We made sure that we come, we spend exactly 1150. But if I get only 12% returns, I will have 1120 rupees. It is much higher than all the other investments that I would have got. Right? Much higher than all the investments that I would have, the alternatives. But still, it is less than my target. I expected 1150 back. I plan to spend all my 1150, but I received only 1120. So I'll have to come up with those extra 30 rupees from somewhere. Maybe I'll borrow. Maybe I'll ask you all to pitch in 30 rupees. Or maybe I would say we will reduce our bill. Okay. I will not, let's say, eat a dish of 30 rupees. So I have to change my plans because I get less return. So that is another risk that I am taking. So risk does not always means that you will lose all your money. Okay. Risk also means that you will get less than what you had expected. Okay. So similarly, all the factors where we said we might invest gives me some kind of return value. That would be the expected return, and I can calculate how much risky that investment is. And these two factors, risk and returns, are very much related to each other. Rather, we say the higher risk we take, the higher returns we'll get. That's the basis of this whole CM2 financial modeling. Okay. So throughout this, we are going to figure out how to calculate risk, how to calculate returns, and how to model them so that we figure out the best relationship between risk and returns. Now, these are the 21 chapters that are part of our course. You can see here. Now, we are going to go from very basics. Okay, basics of financial modeling, not the part that we studied in CM1. No, we are talking about now investment. If I invest certain amount of money, what can I expect as returns? Okay, so we are going to work with stochastic models. Okay, we are going to work with stochastic models. Now we have three types of models. The first is called as deterministic model. The second, statistical models. And the third is stochastic models. Now what are the differences between these three? We have deterministic, statistical, stochastic. When I talk about, these are all models. So when I'm talking about deterministic model, can anybody give me an example what a deterministic model would be? Now these are all predictive models. We are talking about predictive models. We are trying to predict something using this. So can anybody tell me any example of deterministic model? It can be anything where you are trying to predict something and you used some formula and got an answer. Now, do you know, I think everybody uses a calendar. Okay. Now, in a calendar, there are, I don't know whether we'll have double L or single L. Single L, I think. In a calendar, they tell you when there will be a solar eclipse and lunar eclipse. Now, precisely on those dates, you will find solar eclipse and lunar eclipse. Rather, for the next 20,000 years also, you can predict when you will find solar eclipse and lunar eclipse. Very easily you can find where the solar eclipse and lunar eclipses. Actually, weather forecasting is not deterministic. I'll talk about it, why and why not. Okay. So solar eclipse and lunar eclipse, for the next 10,000, 20,000 years, if I predict, I will be able to do it. Now, by any chance, if at your home, there might be Hindi calendar or Marathi calendar or a regional whatever language calendar. Okay, there usually the holidays that we have are not related to the dates, right? Holidays keep on shifting. They are related to tithis, right? Okay. Now, who decides what those tithis are, when those tithis are going to come? Sometimes Diwali comes in October, sometimes Diwali comes in November, sometimes Diwali comes in September, right? Who decides that? So these are all mathematical formulas that has been designed, many thousands of years ago. And we still use them to predict what would happen. Those are related to lunar calendars. Okay, so the Indian calendars are lunar calendars. The English calendar is a solar calendar. Okay, it depends on the, one day is according to the sun's rotation, and Indian calendars are lunar calendars. Okay, so anyways, both of them are, the formulas that we have are very accurate to predict when the next solar eclipse, when the next lunar eclipse will lie, when the holidays are going to be, when the sun is at its peak, when we'll expect winter, when we'll expect summer. All of these are part of formulas, part of mathematical calculations that were done thousands of years ago and still are accurate. Those kind of calculation, those kind of models that are mathematical in nature, they are mathematical in nature, they are called as deterministic models. When I say mathematical in nature, all the parameters that we are talking about, they are known parameters and fixed parameters. Okay, so for models, the values that we'll require are known and fixed. In such cases, we call them as deterministic model. Okay, it's purely mathematical in nature. Okay, simply when I say I will drop a ball from this height, how much time will it reach to how much time it will take to reach the ground? Those are determined by Newton's laws, right? We can easily calculate it. That is again mathematical in nature. That's called deterministic. Rolling a dice is not deterministic. Okay, weather forecasting, rolling a dice, these are not deterministic. Okay, so deterministic, the outcome that we are trying to predict is basically just a single formula, and if we put our input values in the formula, we will get our output, and that will be a perfect answer. Okay, so when I say when will Earth, Moon and Sun come in a straight line such that there's a solar eclipse, you can easily calculate that mathematically. Okay. You can easily calculate when there will be a lunar eclipse. You can calculate that mathematically, and it will not change for the next many thousands of years. So those are mathematical formulas where the parameters are known and they are fixed. That kind of models are called deterministic, where everything is already determined. Now we have statistical models. Now actually rolling a dice would be a statistical model. In statistical model, what happens is outcomes are fixed, are known. Outcomes are known. Their probabilities are known. But still we will not be able to predict the next outcome. Still, next outcome cannot be predicted. So what we do is we use statistics. So simple example, rolling a dice. Rolling a dice, you know what are the total outcomes, correct? You have 1, 2, 3, 4, 5, 6. You know how likely each one are going to be, how likely each one will appear. That is probability is 1 by 6. But still you cannot predict the next outcome. So any statistical formula or anywhere we use probabilistic modeling will come into statistical modeling. Okay. Now stochastic modeling is just statistical modeling, that is probability using probabilities, statistical, with time. Okay, that means there are changes that are happening with time as well. Okay, so such as stochastic modeling or stochastic models are the statistical models that are moving with time. Okay, now everybody has studied linear models, right? Linear regression. In CS1 we have all studied linear regression. Now I can use linear regression to make all three types of models. Okay, so if I say y is equals to alpha plus beta x, this can be any three types of model: deterministic, statistical or stochastic. So if I say that these values alpha and beta are fixed and never change, if alpha and beta are fixed and they never change, that becomes a deterministic model. Okay, that becomes a deterministic model. Now if I say alpha and beta may change slightly, these two values, these are the parameters, may change slightly from a group of values, and how likely a value might be, I'll have to use probabilities to determine it. That becomes statistical modeling. That is why we use alpha hat and beta hat, and we also still have errors. This is the model that we use. Alpha hat and beta hat are the most likely values, and still we will have some errors. That becomes a statistical model. Now if I say that these alpha and beta are unknown values that may change with time, that means if I make it time based, if I say it is alpha t plus beta t x plus errors, these errors are going to be the what do we say, the indicator that this is a statistical model. Okay, that we are not able to perfectly predict what the value of y would be. Okay, but this alpha and beta are also changing with time. As time is moving along, the alpha and beta are also changing, so that becomes a stochastic model. Okay, so if I say weather forecasting will come into a stochastic model because it is statistical in nature. I'm not able to perfectly predict, and also we have to relate it to the time, because yesterday I saw rainfall, today the temperature will be less, or today also I might see a rainfall. So what I'm doing is, with time I'm relating my parameters. In summer season we'll see a lot more heat and less rainfall. In rainy season I will see more rainfall. In winter season I will see colder climates. Right? What I'm doing is, with time I'm changing my prediction. Right? So if I want to know the exact temperature, I'll change certain parameters to figure out what the temperature might be. And still, I'll not be able to predict the exact temperature or exact amount of rainfall. Right? We all know many times there is prediction of rainfall. We take our umbrella and it does not rain. Many times there is no prediction of rainfall. We don't take our umbrella and, it rains heavily. Correct? So that is statistical in nature. We were able to predict, but it was not accurate. Okay, it's accurate most of the times, right? So the weather forecasting comes here in stochastic. Okay. These are also called as time series. The models that are statistical in nature, that move with time. Okay. Now, our concentration will be on the stochastic models, specifically designed for financial modeling. Okay. Now, today we are going to start with this chapter 5. Now, these are also very important chapters. We'll go through them later. But today I'm going to start with chapter 5. Okay. We have stochastic model of investment returns. It's the basis of all the things that we are going to learn later. So we just talked about deterministic and stochastic differences. Right? So whenever I'm talking about investment, whenever I talk about investment, can you tell me, do we have a deterministic model in investment? Because clearly the chapter name is stochastic model of investment returns. So clearly we have stochastic models. But do we have deterministic models? Perfect. So Purva says we have FD, fixed deposit. Okay. Now fixed deposit will come into a deterministic model. We'll say fixed deposit, the rate of returns is known, the number of years for which we are keeping this fixed deposit is known. Okay, these are the two main terms that may vary, and of course the amount that we are investing is known. Okay, so using this we can easily calculate how much future value or how much accumulated value we'll get after n years. So fixed deposit becomes a deterministic model. But if I say I'm not going to keep my fixed deposit today, I'm not opening a fixed deposit today, I don't have that money. But let's say in 1 year, I am going to have, let's say 2 lakh rupees. Okay, after 1 year, I will have 2 lakh rupees. At that time, I'll make a fixed deposit. Okay. At that time, I am going to make a fixed deposit for, let's say, next 3 years. So today, I don't have anything. I'll get 2 lakh. Let's say 2000. I like to write it in numbers. So 2000 I'm going to get at time 1. So today I have nothing. I'll get 2000 rupees at time 1. I'll invest that in fixed deposit for next 3 years. Now what kind of model is this? Is this deterministic or stochastic? We'll not talk about statistical because statisticals are included in stochastic models. Okay, so is this deterministic or is this stochastic? So Purva says deterministic, Dheer says stochastic. Anybody tiebreaker here? Now think about it. We said for a fixed deposit we had 3 parameters that were known to us. We had rate of interest, we had number of years of investment, and we had the amount of investment. Out of these 3, 2 are clearly given here. We have the amount of investment, we have the number of years of investment. But we don't have the rate of interest given here. Okay. And we are not sure whether today's fixed deposit rate of interest is the same that is going to be in 1 year's time. Rather, nowadays, if you just scan, last 2-3 months newspapers or news articles, whatever, online news articles, you will find that the fixed deposit rate of interest offered by different banks keep on changing. Every few months they keep on changing slightly, either they increase or slightly decrease for at least certain number of investments, fixed deposit. Okay. I'm not sure how much aware you are or how much do you understand about the fixed deposit market, but one thing we can do is we can always search FD rates of SBI. You can do it for any other bank also. SBI is the most common one, so that is why just want to show you. So you can search and you can check. Now you have 2 types of fixed deposit, for general public and for senior citizens. Senior citizens will always get 0.5% more than general public, so we are not going to worry about the senior citizen part. But the general public part, you'll see here you have two different rates of interest given. Existing rates for public and revised rates for public. Okay. With respect to 12, 15.2, and this is 12. Okay. These are, I guess, old rates. These are just new rates. Okay. I think that's what it is. Something like that. So they have given you two rates. These are the existing rates and these are the old rates, I think. Okay. So you can see the rate of interest for 7 days to 45 days, the rate of interest is very less. So if you are keeping your fixed deposit for 7 days to 45 days, from 46 to 179 days, you have 4.5. And as you go along, for different tenure, you have a different rate of interest. And then it will peak. So it's peaking here, 2 years to 3 years, and then it goes down again. So there is this is the pattern that you will see for every time when you check this. Okay, so let's say next time you check it after 3 months, the rates might be different. Okay, but the pattern will remain same. Okay, so we'll discuss why this pattern exists later on. Okay, we have a lot of chapters dedicated to these kind of examples, so we'll talk about it later on. But as I said, these rates will keep on changing. You can see here on, I think this should be 2024. They just mistakenly wrote it as 2023 here. Okay, this should be 2024, February 2024. Okay. So in December 2023, we had these rates, and on February 2024, we have these rates. So within those 3 months or 2 months, they have changed the rate of interest. So that happens. So I'm not sure what would be the rate of interest that I'll get after 1 year. If I'm not sure what rate of interest I'll get after 1 year, then it becomes a stochastic model. Of course, I should know the possibility, and I should also know how likely it is, so that I get those values. Okay, so this is an example for a stochastic model of investment return. Okay. Just because we have some unknown value, it may become statistical in nature, and that is why it can be stochastic model. But there has to be something unknown, right? If everything is known, then it becomes a deterministic model. So let's say I take an example. I say rate of interest for this fixed deposit. There is 3 possibilities. I may get, say, 5% returns, 7% returns, or 9% returns. These are all per annum. I may get 5%, 7%, or 9%. Okay, we have probabilities. I'll write probabilities here. I'll say there is 0.7% chance, 0.2, and 0.1%. Let's say these are the probabilities. I have 70% chance that the rate of interest is 5%, 20% chance that it will be 7%, and 9% chance that it will be, 10% chance that it will be 9%. These are the probabilities, right? Now this becomes a stochastic model. Okay, this becomes a stochastic model because we know all the possible values, we know the probability, and of course this may change with time. Okay. The first thing is we'll find the expected value of ik and variance of ik. Can you find that for me? I hope everybody has calculator, and the calculator that I use for IFOA the calculator I recommend is Casio FX 991 ES Plus, and for IAI Casio FX 82 ES Plus. So if you're using any calculator other than this, in IFOA it is still allowed, no problem. In IAI there are a lot of restrictions on calculator use. So I'll be showing you any new techniques that we learn of this calculator using this calculator here, this calculator app here, but I would recommend that you should always use the physical calculator. Don't use mobile calculator or any app for calculation purposes, because I would like you to practice a lot. Okay, the more you practice on the real calculator, the faster you will get, and it will save a lot of time. So expected value, we'll say 5% into probability of 0.7 plus 7% to 0.2 plus 9% into 0.1. So 5.8. For variance, we'll have to find expected value of ik square. Now another thing, okay, I would expect you all to participate, and of course this is your first class. I'm not sure whether you are prepared for calculations and stuff, but you should always keep your calculator handy. Okay. So what we'll have here is, we'll have 5 square into 0.7 plus 7 square into 0.2 plus 9 square into 0.1. So you can just use the previous equation, and just use this previous equation and edit, put squares. $35.4. Now could you tell me the units? The expected value units are going to be percentage, but what will be the units of ik square? We'll write it as percentage. Okay, it's basically percentage square because I have squared the percentage. So we'll write it as percentage. variance again, variance will also have percentage as the units. Is this correct? Is everybody getting the same answers? Okay, good. So this expected value of IK is the expected returns. Okay, this is the expected returns. So we don't know the exact rate of interest that we'll get in this fixed deposit, but the expected rate of interest that I'm expecting is 5.8%. Okay, 5.8% for the next 3 years. I can easily calculate how much returns I'm going to get. Okay. Can I calculate that? Okay, first of all, this expected returns, we'll write it as J. So always remember expected value of IK. We are writing it as IK because it is for the year K. Okay, so year 1, year 2, year 3, whatever it might be. We'll always write it as J, and variance of IK, we'll write it as S square. So J is nothing but the expected returns or expected rate of returns, and variance is the measure of risk. Now, there is a whole chapter on measure of investment risk. Okay. There we will learn many different types of risks, but one of them is variance, and we'll see that variance is the most widely used measure of risk. Okay. So here we got the returns, that is J, and the risk amount, that is variance. Okay, so we are talking about risk and returns for an investment. But this is just expected rate of interest, and you might say the risk that I am going to take if I invest in this fixed deposit. But the fixed deposit is going for 3 years. Right? So fixed deposit is going for 3 years. How much return am I expecting? I'll say accumulation. Accumulation using fixed rate of return. This is also called as fixed rate model. So we are saying that the expected rate of interest is 5.8%. expected rate of interest is 5.8%. I am investing that for the next 3 years. Okay, 2000 rupees I'm investing for the next 3 years. How much will I get after 3 years? So that becomes my expected accumulated value, okay, in this fixed rate model. So I'll say expected value accumulation for 3 years. Okay, whatever, if you want you can just write future value for 3 years. What am I expecting? So I'll say 2000 invested for 3 years at this expected rate of interest. Is this clear? Any problem here? So the accumulation amount that I will have after 3 years is going to be 2368.57. So what did we do? We just used the fixed rate. That would be the expected rate of return. We just use the expected rate of return, and we know the rate of interest will remain same for the whole 3 years because we are talking about fixed deposit. So the rate of interest will remain same. It was unknown, so we calculated the expected rate. But is 5.8% rate of interest actually possible? So after 1 year, when I come to invest that 2000 rupees, will the bank offer me 5.8%? Bank is not going to offer me 5.8%. Bank is going to offer me either 5%, 7% or 9%. These are the only 3 possible values. Bank is not going to offer me 5.8%. Right? So the bank is not going to offer me 5.8%. So is this calculation of expected future value correct? Maybe, maybe not. I will give you another way of calculating this accumulation. We'll say expected accumulation. Okay. So first what we did was we fixed a rate of returns and used that to calculate accumulation. Now we are calculating the expected accumulation. So here I'll say the rate of interest is 5%, 7% and 9%. So using that, I can easily find the accumulation factor that I'm going to get in 3 years. I will get either 1.05 raised to 3 or 1.07 raised to 3 or 1.09 raised to 3 with the probabilities 0.7, 0.2, 0.1. So now I can find the expected accumulation. You can say expected accumulation factor for these 3 years and if I want to find my expected future value or expected accumulation, I'll just multiply 2000 this 1.184849 So clearly I have different answers. I don't have the same answers. Could you tell me which one is more accurate, the first or the second? Which one is correct? Can you tell me which one is correct? Hmm? See, whenever I'm asking you a question, I'm not expecting you to always know the correct answer. Okay, I always expect us to learn, but I want your opinion because many times we have some preconceived notions, and because of that, later on it might pose a problem. So first, if you think about it, if you yourself think of a reason why first might be correct or why second might be correct, and then if I tell you the exact reason, you will understand how much it was correct and how much it was wrong. And we are here to learn. I'm not expecting you to know everything. If you already know everything, why would you come to me for learning, right? Okay, so you should answer. So you have now option 1, option 2, or maybe both. That is another option, or neither. So you have 4 options to answer from. Okay, so I would expect you all to answer. Okay, no, don't think about it whether it is going to be correct or wrong. That is not the point here. The point here is learning. So I've got, so the options we have both or neither. These are the 4 options. Okay, so I've got 1 vote for 2 and 2 votes for both. Others, I would like you all to also contribute. And this is not democracy. I'm going to tell you what's the correct answer, and it's not going to be the one who gets the highest votes, right? So that is why I'm saying you should voice your opinion. Does not matter whether it is correct or wrong. Don't worry about it. So we've got 2 votes here. Come on quickly. Anybody else wants to, or should I talk about it? I see few of my old students, so I expected an answer. That it is both and neither. It is both and neither. Because when it comes to statistics, nothing is 100% right and nothing is 100% wrong. Should always remember this. Okay. So this was just a tricky question. Okay, always remember when it comes to statistics, nothing is 100% right and nothing is 100% wrong. So when I'm saying that, would my expected returns be this, or would my expected returns will be this? You can see both are very near to each other. Both are very near to each other. The difference is almost 1 rupee for the 2000 rupees that we had invested. So the error is about 1 by 2000. For every 2000 rupees that you are investing, there's an error of 1 rupee. That's not a very big, error. Right? That's not a very big error. So it does not matter whether these two are slightly different. They both are correct. But if we actually see, if we experience this, that after 1 year we invest 2000 rupees for another 3 years, okay, and see how much returns am I getting, both of these are going to be wrong. The answer will be not this and definitely not this. None of these would be the actual answers. Okay. So both are correct and neither of them are correct. So always remember, this is expected value. What are we expecting? Because there is a fluctuation, because there is some statistics involved, because there is some probability involved, you are not always going to get an accurate answer. Right? So if it is 5%, how much are you going to get? 2000 into 1.05 raised to 3. That is 2315. This is what you are going to get if it is 5%. If it is 7%, you are going to get 2450. And if it is 9%, you are going to get 2590. So these are the 3 values that you might actually get. These are the 3 values that you will actually get. Either 2315, 2450 or 2590. None of these answers are this or this. So you'll say both are wrong. You'll say both are wrong. But if I invest in this type of model again and again and again, if I invest in this type of model again and again and again, what we'll find is 70% of the time the probability was 70% of the time the rate of interest was 5%. 20% of the time the rate of interest was 7%, and 10% of the time the rate of interest was 9%. So if I invest it again and again and again, averagely I will get something like this or this. So if I'm repeatedly investing in similar models again and again and again, so I will get that my average returns is this much. One of these, as I said, both are almost same. There's a very slight error, both are almost same. So in such case, both are correct. And if I'm only talking about one case, if I'm investing only once, then both are wrong. Right? Am I right about it? So probabilities will prevail only when you do that thing repeatedly. Okay. If you do that thing repeatedly, only then the probabilities will prevail. That is why we cannot predict the next outcome of the dice. But if I am rolling that dice 6,000 times, I can predict that about 1,000 times I'm going to get 1, 1,000 times I'll get 2, 1,000 times I'll get 3, and so on. It's going to be nearly the same. Right. So if I do it repeatedly, my expected returns will be what I'm going to get averagely. Right? But if I do it only once, I'll not be able to predict it. Okay, that's the point. Okay, here whatever predictions we are doing, it will never be accurate because these are all stochastic in nature. Okay. So whatever prediction we do, whatever methods we are going to use for prediction, they are never going to be 100% accurate, but they are not going to be useless. They are not going to be useless. Okay. There are many ways we can understand these outcomes that we are going to get, the expected values and the variances. We are going to learn throughout this course how we are going to use these values to understand how the market is behaving. Like here, we are just going to learn the basics. Even these chapters are about different basics. So throughout history, people have always been, obsessed to predict the future. Everybody wants to predict the future. Okay, if I ask you, you will also like to predict the future. Right now, a lot of you might be watching IPL. Everybody wants to predict who is going to win the championship. Right? Everybody wants to predict who is going to win today's match. Okay. There are so many games related to it. There's so much gambling happens over it. Right? There's so many things related to predicting the future. When we go to financial world, if you open one of the business news channels, throughout the day what they are doing is trying to predict whether the stocks will go up, whether the stocks will go down, how much up, how much down. Everybody's it's not today's obsession. This obsession has been there forever. Everybody wants to predict what would happen. So we are going to go through step by step how we are going to create a model. I can today give you a exact model what people use to actually predict the stock market. That is part of our course. This Black-Scholes models, okay, is very widely used to predict the option markets as well as the stock markets, and that is part of our course. But if we directly jump to that, you'll not able to understand how I can manipulate that Black-Scholes models to work for me. Okay, what do we put as the parameters? How do we figure out the inputs? We have to learn how we build up that Black-Scholes model. So all of these chapters are just related to understanding how we use these Black-Scholes models, this binomial model, then we have Brownian motion and martingales. How we are going to use these models to predict the financial market, not only stock market, but as we see, we have option pricings, futures, forward contracts. These are all different things that you can predict using these models and how they are going to help you. So the financial expert who is sitting there on the business channel, business news channel, and advising you, this is what is happening and this is what you should expect. Okay, if he's saying that stock market is going to go up, stock market is going to go down, that is more of an experience thing. He knows because he has been following the trends. But if he's using this Black-Scholes model, he will say that today the stock value is 57, buy it at 57, sell it at 60, don't go above 60 because it will fall after 62. Okay, so don't expect it to go a lot above 60. So as soon as it reaches 60, sell the stock. If he's talking like this, what he's doing is he's using one of these modeling techniques to figure out how the stock market is behaving. Okay. So that is what we are going to learn in this course. Now, other than that, as I said, stock market, that is something we are going to learn to predict. We are going to learn how do we measure, invest, and diversify. Then we have many time series. These are all different time series that we are going to learn for a long-term investment. So you might say this Black-Scholes formulas or these stock market predictions are used for short-term investment, so that you can figure out how well can we get our returns. These time series type of calculations are done for long-term investments. So we are going to learn how do we manage our own investments, at least theoretically. There are a lot of practical factors that you should learn before investing in stock market. So you should definitely learn these theoretical points, but also a lot of practical points before you invest. Okay, because investment is risky. Right? So anyways, this is how the course is designed. We are going to go from very basics of modeling. So today we started with the stochastic models of investment returns. So as we see, we will be contradicting ourselves again and again and again. But I'll always ask you, do you see an real life application? I'll try to always give you examples of real life applications. Every model that we are studying, that has a real life application. Like, this is the most useless type of calculation because this is the most unrealistic calculation. I gave you a scenario where it is possible, right? These are called as simple models. These are called as simple models. We have fixed rate model, I'm just writing accumulation using J, that is accumulation using expected rate of return, and then expected accumulation. These will not be equal, these two will not be equal, but in both of these, what we are doing is we are using fixed rate model. That means the rate of interest is fixed throughout the time period, right? It is fixed throughout the time period. We may have we also have variable rate models. Okay, in simple models we'll have variable rate models as well. Okay, so before we go to variable rate models, I want us to do a question from the book. Just give me a second. Now this is chapter 5, page number 4. See, in the book there are they don't write the question numbers for questions in the book. Okay, between the chapters. So what I do is I write according to their page numbers. So I'll say chapter 5, page 4 question. Very similar to what we just did. The returns from an investment are assumed to conform to that to the fixed rate model with the distribution of rates as specified below. Calculate the expected accumulated value at the end of 5 years of an initial investment of 5,000. And second part, you can see calculate the accumulated value at the mean rate of return. Mean rate of return would be expected value, that is J, whereas here we want the expected accumulation. The expected accumulation factor or expected accumulation would be how much? We should write the formula at least at the beginning. The examination will not need to. expected accumulated value. For the second part, we'll have to calculate the expected rate of return or mean rate of return. J, that is our mean rate of return. So the mean rate of return is 7.8%. At that mean rate of returns, if I want to find the accumulated value, accumulation at mean rate of return. Any problem here? Here you can also find variance for accumulated value. Okay, variance of accumulated value you can find, but you will not be finding accumulation at variance rate of return. No, that is not going to happen, right? So if I want to find variance of accumulated value, I would say it is expected value of a 0,5 square minus expected value whole square. To find this value, all I would do is raise to 10, raise to 10, raise to 10. Very simple, right? At any point, if you feel like you did not understand, you can ask me to repeat. Don't ever feel like that whether I don't know something sir must have taught before or something. No, does not matter. Okay, you can ask me at any time to repeat. If I feel like we are using some prior knowledge, I will remind you of that. Okay. So I think there is a question of variance later. Yeah, calculate the variance of the accumulated value of the investment in the previous question. Okay, so you can say expected value of 1 plus ik raised to 10. Okay, that is what you will use to calculate it. So there is a difference in expected accumulated value and accumulation at expected rate of return or mean rate of return. There will always be a difference, slight difference, but there will always be a difference. In both of these, one thing is common, that the rate of interest is fixed for the whole time period. Okay. For the whole time period, the rate of interest is fixed. Okay. Now we may have variable rate of interest. That means, let's say each year the rate of interest keeps on changing. At the beginning we will worry about yearly rate of interest. Later on we can decrease the time period. So we may have variable rate of interest. Now everybody has understood what a mutual fund is. Now even though you might have simple knowledge of mutual fund, but if you just search mutual funds, okay, you will always find something like mid cap index funds. There are many different types of mutual funds. Okay, so there are certain websites that are there just so that you can understand different types of investment strategies in mutual funds. So let's say this is Investopedia. I think it will show me different types of mutual funds. Okay, we don't want to read so much. I just want to see the options. Money control will, I think, give me different options. Yeah. Now, if you see this, we have large cap, mid cap, flexi cap, focused, small cap, ELSS, aggressive hybrid, short term, corporate bonds, banking, PSUs. A lot of them you will understand by their name. Index funds, these invest their money in specific indexes. You can see Nifty 50, then most of them are in Nifty 50, then Nasdaq 100. Okay, these are certain kinds of indexes. We'll talk about it, we'll discuss that indexes later. But mutual funds that specifically invest in different types of indexes will be index funds. Okay, banking and PSU debt, they are specifically investing in different banks and PSU debts. Okay, so it is specific type of mutual fund. Then corporate bonds, these mutual funds invest specifically in corporate bonds. Okay, bonds released by different companies. You can see HDFC corporate bond fund, Sudharam corporate bond fund. Then short term, as the name suggests, these will be mutual funds that are investing in short term types of bonds or maybe debts or something else. You can see Axis short term, HDFC short term, whatever. Correct. Aggressive, hybrid. Somebody who is new to mutual fund may not understand, but most of you might have heard the words large cap, mid cap, and small cap. Do you know what does this mean? Large cap, mid cap, small cap. Cap is short form for capital. Okay, so they are different types of companies. These are large capital companies, these are mid capital companies, and these are small capital companies, in which these companies are these mutual funds are being invested. Now, yeah, size of company, you're correct about it. This is size of company, or the yeah, size of company. Let's say size of company. Just see the we'll just compare. Let's say HDFC, large cap, 3-year returns is, no, we'll just, okay, 3 years returns is 22.5 here in 5 years. Let's see just 3 years return. HDFC large cap is giving me 22.35%. Mid cap, okay, here we don't have HDFC, but this, okay, let's see the highest returns in any one of them. Here it was 22. In mid cap, here it is 27. Okay, and small cap 36. Right. So do you get an idea? Here the highest returns that I got in large cap was 22.35% in 3 years. In mid cap it was 27%, and in small cap it was 36%. Okay, now saying large cap is giving me 22%, mid cap is giving me 27%, small cap is giving me 32%. Now we understand mutual funds. We say that mutual funds are created so that we can diversify risk. Then why is there such a big discrepancy in the returns that we are getting? Why somewhere I'm getting 22%, somewhere I'm getting 27%, and somewhere I'm getting 32%? Rather, if you see the average of all three, large cap average was 17% or 18%, mid cap 25-26%, and small cap is 29-28%, 29-30%. So clearly small caps are giving you large returns compared to large cap. So what does this mean? Large capital company, okay, or the size of the company is large. So every investment that I'm doing in this mutual fund is in large companies. Okay, so Apurva, you're saying small caps share price have more changes of growth, more chances of growth, but definitely more riskier. Yes. So we are talking about size of company. This is a large company, medium company, and a small company. Okay, so a small company like a startup, there's a large potential of growth. The startup industry will grow very rapidly, but the chances that that specific company will grow rapidly is very less. The company may not do well and just shut down. So the risk that you're taking is large here. Risk large. Okay, so the potential for a very small company to grow very rapidly is very high. But the risk that the company will not do well and shut down is also very high. Mid cap, the risk is mid. And for large cap, risk is small, or yeah, Usually we should write high and low. Okay, we'll be consistent in the words that we are using. High risk, low risk, mid risk. Okay, so we have different level of risk, and that is why we have different rates of returns. Okay, so for a specific mutual fund, if you go and try to buy a mutual fund, let's say I am talking about this mutual fund. Okay, so they have a certain expectation of returns. Okay, so at any given point in time, okay, take a fixed area. I'm not talking about from this May 23 to April 24. No, rather if I can get all. Okay, this is there. Okay, this is XIRR. What are they showing? I don't want this. No. SIP returns. I want XIRR. XIRR. See, this is the problem. This is the absolute returns that they are showing you. Okay, so absolute returns. You don't want absolute returns. So this is stock market. They are just showing stock market. I think these percentages 1 year, in past 1 year, the returns that they have earned is 36%, here 22%, here 22%, 15, 14, 18. Okay, now usually, see, right now, because India is doing better than other countries over the world, that is why the growth rate is comparatively higher. Okay, that's the main reason I'm not seeing here consistency. But the aim of a mutual fund is always to keep a consistent return. Okay, they try to keep a consistent return. They don't try to go very high, or they don't try to go very low. They try to keep a consistent return, but it will always be variable. Like here, let's just see these 3 years. Okay, since inception, the rate of interest is 18%. In the past 10 years, it has been 14%. In the past 5 years, it has been 15%. So if I have the data of these years, the previous years, you will find it is very much consistent. Somewhere around 15 to 18%, or you can say somewhere around 13 to 18%. It would have been very consistent. In past few years, it has increased a lot more than the average. Okay, but that's a good thing, because mutual funds are giving you more returns. They try to keep the risk rate, the risk amount consistent, so that the returns that you are getting are consistent. Okay, I could not get a good example here. Okay, most likely mid will be consistent. See, as I said, because India is doing comparatively well than the other countries, this is what we have, very high returns compared to the previous years. You can see averagely this person, this this mutual fund has been earning around 17%. In past 10 years also 17%, but last year it is 32%. It's a very high growth compared to what averagely it is doing. Yeah, we'll find this pattern everywhere, unfortunately. Okay, so I'll have to give you next time theoretical examples rather than real examples. Okay, so anyways, for a mutual fund, they are trying to keep a certain level of returns. They are trying to maintain that certain level of the returns. Rather, they are actually trying to maintain a certain level of risk for which you will get maximum returns. We'll learn that later on. Okay, the common sense behind risk and returns. But let's say right now we are trying to maintain a certain level of returns. So I'm every year expecting the returns to be, let's say, somewhere between 18% to 14% to 18%. This is my expectation of returns. I know how likely it is, and because I'm trying to keep the risk level same, you will find that I'm trying to keep the probability similar in this case also. So the rate of interest, I'll again make a simple formula, and I'll say probability is, let's say, something like 0.2, 0.60, something like this. And I'm trying to keep the same risk level and same returns level for every year so that my mutual fund remains the same, consistent. So when I'm saying I'm trying to remain same, sometimes it will be 18%, sometimes 14%, and majority times 16%. That's the returns level that each year I am going to get. But it is going to keep on varying. It is not going to be same. The rate of returns will not remain same. But it will be somewhere in the same range. That is my expectation. For the next 50 years, for the next 30 years, 10 years, whatever you are going to invest for. So each year the rate of interest is varying but remaining in the same range, or we'll say coming from the same distribution. The distribution is not changing, but the rate of interest is varying. That is what our variable rate of interest simple model. Okay. So we are going to learn that next time. I want to keep the last 10 minutes or so for any questions you might have. Any questions? Not only related to what we have studied today. I would like you to ask anything about me, about S.MONK, about CM2 course, anything.
So basically, all the chapters will be in the form of recorded lecture, live lecture, in what format?
Live lectures. So we'll conduct live lectures and I'll also record them. So like this lecture is being recorded, and after a few hours I will always post it in the groups that we are going to be. Okay, so you will have the recorded lectures also, but we'll have live lectures. Okay.
And so that live lectures will be offline or online or flexible both ways.
Mostly online. Okay. So if you are in Mumbai, I will keep certain doubt lectures offline. Okay. But for people who are not in Mumbai, you will have to attend everything online. Okay. Lectures will be online. And we'll keep
And
it
so
on.
I had asked that basically that for the offline lectures, if majority of the people are from the central line, then the class will be in Dadar. So anything fixed that?
No, we don't have a place at Dadar right now. So we used to have it, but even that building has gone to reconstruction. So as I said, offline we will conduct only in Vile Parle, and see, that will be doubt lectures only. So I can connect online on those days also, but specifically for some people, they feel like online lectures I'm not able to understand perfectly or something. So for them I will keep a certain number of doubt lectures offline also. Okay. Chalo. Any other question?
No, sir.
So see, because it will not be every single week, sometime you can travel a little bit more. I know for people who are coming from Dombivli and stuff, it's a very long route, right, to Ville Parle. But unfortunately, we don't have a place right now in Dadar. That's a big problem. So today was a demo lecture. Okay, so from next week we are going to start lectures. Okay, next Saturday, Sunday. CM1B. Are you talking about CM2B or CM1B? CM2B. So we'll have it on Excel. It will be online here. So as I said, if you are in Mumbai, you can always contact me and we can meet at the Ville Parle Institute if you have problems. See, sometimes I understand it's very difficult to clear your problems online. That happens sometimes. But you will find majority of your problems can be cleared very easily here. Okay, we can interact very easily. Through Google Meet, you can share your screen as well. So when we are doing Excel, and if you find that you're not able to get, and I'm not able to get your problems, you can share your screen and explain, sir, see, this is the problem that I'm getting. So that is also possible. So we'll try to do that first, and if you still are not able to get are not able to be able to clear your doubts, you can definitely come to Ville Parle, because some lectures I will be streaming from the Ville Parle Institute as well, because Saturday, Sundays I'll be there many times and I'll be streaming online from there. So whenever that is the case, I can inform you all, and if you want to, you can come, right?
So anytime the online lectures which will be conducted for the chapters, so it will be in the weekends only, right?
Yes, weekends only. Okay. So I might ask you all to, maybe some doubt lectures on weekdays. I might ask you to connect, but the lectures, all the study lectures will be on weekend only. Even Excel lectures I'll keep on weekend only, so that you all can attend live.
सर any specific period मतलब कितने टाइम पहले मतलब पोर्शन खत्म हो जाएगा कैसे?
So see, our examination is going to be on September. अभी तो डेट भी आ गई होगी. Let me just check. We always try to complete our lectures 1 month before the examination. So IFOA timetable. Key dates. This is April, this is September. So you can see September, our CM2 examination is on 17th. So let's say we'll count 15th. So 15th August is going to be our date to complete the whole course. Okay, 15th August. Okay, paper A, paper B will complete the course by 15th August, maybe 1 or 2 days, here and there. And after that, we'll consistently have doubt lectures, tests, mock tests, okay. So the last month will all be about practicing.
So any specific methodology to study basically पहले live lecture देखने you have to see the live lecture, then solve the practice questions, any specific method?
See, follow the live lectures. That's going to be very important. And every class I will always say that solve this much question, solve that question. See, after the lecture is over, maybe let's say Saturday, Sunday, you watch the lectures, and throughout the week, first thing you have to do is revise everything. You are going to make your notes, right? Go through the chapter. So right now we did small part of the chapter, right? The statistic investment. There is chapter 8. This is chapter 5. We hardly did anything in this. You can see varying rate model. Before this, we have all the simple models, fixed rate models, right? So we did hardly 2-3 pages today. You can go through that. See, I talk a lot, I give you examples, but many times what they are writing here is you know, you get to understand something in a different way. Okay, I try to explain it with practical examples, but many times just reading it from the mathematical point of view is much more clearer, right? So definitely go through what you are doing today and then solve the questions. We solved this question. There are more questions here. Okay, so you should always go through those questions. Then I will always say when we are done with a chapter that you should solve from the revision notes, from the assignments, those kind of things, you should definitely solve them. And if you see, I always say keep 5 days for studying and 2 days for covering it up. So we'll always make timetable and we'll always fall short of that timetable. So always keep gaps. So in a week, always study for 5 days and keep 2 days for covering it up, because we'll always fall short, and in those 2 days you should cover back up and not fall short for the next week, right? So keep a gap and accordingly keep on covering up if you are falling short. At the beginning you will feel like we don't have a lot to study. So that is the case, no problem. Go through the notes. Make sure your typing speed is fast. Everybody knows about our examination being online now, right? So your typing speed should be fast. Make sure the topics that I talked about at the beginning of CM1 and CS1, you are well versed in it. Okay, the formulas that we used to use there, keep them with you as a formula sheet. Okay, and as we are going along, start making formula sheet for the CM2 in Word. Okay, so you will have practice of typing, and at any point if you feel like you have problem in typing, ask me. So is there any changes in CM2 syllabus recently? No, I don't think so. At least till 2023 there were no changes. Okay, somebody told me that there has been change in 2024. I'll check, but I don't think there has been, because somebody said that ruin theory and stuff has been removed from the course. I did not find any document of that. So it is, so right now from what I know, I have this 2019 book and there has not been any changes till now. These are the topics that we are going to have, because somebody said that ruin theory has been removed from the course, but they are asking questions of, because it has not been removed from the course. Even in the April 2024 they asked questions of ruin theory. Okay, so they have not removed it from the course. So this is the course. Okay, any other doubt? Any other question? So see, there are a few chapters of theory. So chapter 1, chapter 2 and chapter 3 are theory chapters. Even later on, we'll have a lot of theory in certain chapters. Okay, so our portion is divided such that around 20 to 30% you will have theory questions. Okay, and it's not as if you have to learn everything. Okay, ratta nahi marna hai. It's understanding based. Okay, and these are all important chapters for our understanding. So right now, like, I started from chapter 5, but as soon as I complete chapter 5, I'll go back to chapter 1, 2, 3 and 4, and I'll tell you, see, we use this concept in modeling here. Okay, so all of these chapters are very much important for our later on modeling. Okay. It's a very interesting course. Okay. At least I have a lot of fun whenever I study CM2. I'm sure you will have fun too. So if you have any other question, you can call us on this number, right? I think you all have the office number. So, and we'll inform you when the classes will start next week. Okay, Saturday, Sunday. And if you have certain problem in timing, especially Saturday, some people might have problem because if they're working or college or something like that. So please inform us. We might adjust a little bit. Okay. Should we end the class here? Bye. Welcome. Bye.
Thank you, sir. Bye, sir.
Welcome. Bye.